first. Barry, based on what we know, what was your reaction? Were you surprised? And then we'll get into how we feel about the way they're handling it, whether it's Yellen, Biden, because he gave a speech today.
So, okay, there's a lot to unpack here, so I'll just try and be quick here. So this bank had problems because in 2008, under the Dodd-Frank, they were allowed to invest in assets. Now, it wasn't a bad decision necessarily to invest in these assets, but what happened was that they were yielding on $82 billion worth of investments around 2%. Now, it's okay because if you're paying your depositors very little, you can make some spread there. But as you know, when somebody deposits money in your bank, you don't have all those assets on hand. You keep roughly 10%. The rest you lend out to try and make the arbitrage, to try and make the spread. That's how banks make money. The problem is that a lot of these investments were now underwater. You see, when you invest in a lot of the bonds that they invested in mortgage-backed securities. So a 3% mortgage equals a 2% coupon because everybody takes a piece. So those 2% coupons, I'm getting 2%. That's okay if I'm paying a half of 1%. I'm making money on it, okay? However, what starts to happen is as the Fed has maniacally raised rates without thinking about the consequences, they're not very good at unintended consequences, they now give people alternatives to move their money. So now you can move your money to a short-term 6-month treasury and get 5%. So people start withdrawing money. Tech companies were doing a little bit more poorly, as we know. They start having less capital. There's less money going in. So what happens is that the bank now has to make up this money. Where do they get it from? They have to now sell assets. Here's the real craziness of it. They had on their books $12 billion positive, but it really wasn't. Because once you started looking deep, what they had was invested in these bonds that were now underwater. Under Dodd-Frank, these are considered now to be no-risk assets. So you do not have to report under Dodd-Frank unrealized losses. They had $15 billion in unrealized losses. This was not a solvent bank. They were $3 billion unsolvent as at the end of last year, which is why the CEO was selling stock, which is why you had insiders getting paid bonuses up front and early. Now, they start to get exposed because Jim Cramer, an amazing 5 weeks ago, touts this as the stock you got to buy. Okay, it is.
Stop it. Jim Cramer was out there doing his thing again.
Are you joking?
February, I swear to you.
Wait,
February.
no. Pull up the video.
We got the video.
Is this the same Jim Cramer that compared Sam Bankman-Fried to Rockefeller or to Andrew Carnegie?
There's actually an ETF which is a contrary to Jim Cramer. But anyway, really on point here.
I'm sending it to you just so you know.
So Jim Cramer on February 8th talks about how the stock's undervalued, how it has room to run is his quote. It was at $320.
Here, watch this. Just
watch this.
Put the audio so we can hear it.
It's the Jim Cramer dead cat bounce.
Watch this.
Year to date is SBV Financial. Don't you want? This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yes, some of them come back here, but the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls
just a few weeks ago,
like
February 8th,
last year,
5 weeks.
It takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is our